But we do have our plenary speaker this afternoon, Thos Gieskes. Thos, welcome indeed to the Nuffield Farming Conference here in Adelaide. And again, thank you most sincerely to the Rabobank for your continued support for Nuffield. Certainly it's not the first conference you have been involved for many years, and we thank you for that. I mean, my remit as chairman this afternoon is very simple. It is to introduce the subject, introduce the speaker, and guide us through the discussion. Very simple introduction to the subject, and a very important subject that we have to discuss in terms of commodity supply, the banking role within that. It is quite interesting. There's an excellent history of money by the Oxford historian Neil Ferguson, The Ascent of Money, and there's been a TV programme about it. And in that, he notes that the evolution of credit and debt was as important as any technological innovation in the rise of civilization, which I thought was a very powerful statement, that perhaps to be of some comfort to you, Thos. He also makes the comment, throughout civilization, there has been a recurrent hostility to finance and financiers, rooted in the idea that they are parasitic on the real economic activities of agriculture and manufacturing. So, having built you up, I'm just going to give you a little rattle on your there. But Thos, thank you very much indeed for joining us this afternoon and for the discussion afterwards. I present you to the floor and to the audience. Thank you.
Thank you very much, Win. Thank you all for allowing me to be here. That's certainly a unique introduction to me. Presented as a parasite. There's no healthy animal without a parasite. It also made me think, and we spoke earlier this morning, and unfortunately I could not be with all the sessions this morning, but I was fortunate to listen in a little bit to the summaries. And mention was made of next year being in Australia the year of the farmer. And I think that's very important, and we as an agricultural bank will certainly support that, and you'll understand that is important to do, and that the image of the farmer should be improved. But I think we need a year of the banker as well. And then because we are really very low in ranking these days globally. It's not just a couple of centuries ago. It's these days, I think, we bankers, or then bankers, whatever way you want to put it, have a mess of it, and we deserve to be really at the bottom end of the picking line. But we as Rabobank try to sort of be a good example also to our peers. So a farmer's banker, that would be the ultimate year then next year. The year also, by the way, for the ones of you who didn't know, next year is also the United Nations year of the cooperative. And Rabobank happens to be a cooperative bank. So we tick all the boxes then. We're farmers and bankers and everything. It's going to be a beautiful year. Just one other remark I'd like to make before we head off with the presentation is a word that I've heard this morning also is creative banking. Maybe from my speech you already get the picture that we try to be as creative as we can be, and confronted with the environment that causes parasites, we still try to survive. But creative banking is indeed an interesting concept, and the presentation will probably not be as creative in that sense as you might hope, but certainly in the discussion afterwards we can go into more creativity maybe. But the one thing I'd like to say up front is that if you want to talk about creative banking, you should basically say creative financing, in my view. And just disassociate it from a traditional bank, because a traditional bank and creative banking is a difficult combination. Whereas if you talk about creative finance, also look at other sources of finance, rather than your traditional bank, that might be an option actually to open up the spectrum for creativity. That doesn't mean to say that we will also be very creative, but as a bank we're also tied within certain boundaries of conservatism. We're bound with, as a cooperative bank, with the obligation to safeguard the capital that we've accumulated over 115 years now, which is over 40 billion euros. But it's just guilder after guilder, now euro after euro, just reserved over those years actually to make us who we are. And we're not going to put that at jeopardy by just being too creative. Okay, that is as a starter basically. What will I talk to you about today? And the title, which I was asked to talk about, are the changing dynamics of commodity supply and the possible solutions for the challenges. So what I'll try to do is paint you quickly a little bit of a big picture. There will be some overlap with presentations you've heard before today, that you've heard before in other locations or instances, but the reality is the reality, and I think it's important also to give our acknowledgement of that reality. So we'll look at high price and volatility, that's the big picture. Then we look at the changing dynamics, the battle for raw materials. We look at the current landscape, that's mostly for Australia, I must say. Being based in Sydney now for a while, and also have a strong tie with the Nuffield Australian chapter. We focused us for now on Australia, but certainly in the Q&A session we can look at other parts of the world. And then we will look at what we think is a direction for solutions. This is the arrow as we see it happening. So this is the, on the demand side, the supply side, things are happening that actually lead to a scarcity. On the demand side, many people have spoken about population growth that we see. We also see the income growing of the people that live on this planet. It leads to dietary shifts, which leads to different type of food requirements. At the same time, we see the biofuels continuing to absorb a lot of what we grow on the planet. Just in Brazil alone, 50% of the sugar, and there's a lot of sugar in Brazil, 50% of it, 50, goes to biofuel. In the US, 40% of corn goes to biofuel. We're still very much focused on this first generation biofuels. There's some initial thoughts, more than thoughts, but some initial movements, developments in the second generation, but they don't overtake what is still being done in the first generation. If you look at the supply side, we see that the arable land erodes. We see that the expansion into new areas, new frontier areas, is not occurring, and it will only occur with significant investments. And there's no incentives basically for certainly for farmer producers to do that. We see yield improvements continue to decline. We see climate variations, and some say it's climate change, but there's a fact that something is becoming a bit more variable and leading to more volatility. And then on top of that, we have governments, and unfortunately we have them everywhere, and they interfere with everything. So when you get to a situation actually where the demand is getting a lot bigger than supply, governments feel obliged to intervene. We've seen Russia, the famous example in Russia with the export ban, which actually had an opposite effect because it meant that the prices of the product in Russia itself went down, which created less of an incentive again for the Russian farmers to farm. So actually where you're trying to protect your population, you erode your own production base. And there's other examples there. Basically, the point where we get in is that the higher prices and the ongoing volatility are becoming such that there's a fundamental shift, and the fundamental, as we see it, there's a scarcity which is coming around now, which will stay around. And when you think of the concept of scarcity, and when governments start to think about scarcity and true scarcity, which means lack of something, you will get very, very strange movements whereby basically the word hoarding has been mentioned. If you live on an island, for instance, and I've lived a little while on a small island, the ship comes in with all the supplies for the supermarket, and the first thing you do is to make sure that everything that was in the supermarket is now in your closet. Because you never know when the next ship is going to come in. Right? And we see it here when a cyclone is about to hit a part of the country, people will make sure they have enough supplies. And that's at the micro level. If those things happen on a global level, with governments actually protecting, allegedly protecting their own population, it will only lead to more distortion, to more volatility, and to less efficiency in the chain, and therefore higher prices. If we talk about those volatile markets and structurally higher prices, this is we bankers love this. Sorry, this is graphs of three types of commodities, prices on CBOT, and what you will see here over those 10 years is a very remarkable, I would say, upward trend. And also remarkable in this picture, for instance, is the grey line, as you can see. Grain is corn, and you see that where we are now, corn will become more expensive than wheat, which was never the case. And that has to do with the famous biofuels on the one hand, and the really low stock that there is in corn at this moment, but also the biofuels that continue to demand. And I'll speak about those biofuels a little bit later as well. So the demand side, I spoke to you about that. The supply side, I spoke to you about that. You know that probably 1% of the arable land per year disappears because of urbanization or other effects that we have. Recreation is one, degradation of the quality. So you'll see that there's no incentives basically for farmers, for the farm price, that is the farm gate price. There's no incentive for farmers to actually take that land into production or to invest in the additional R&D to take the production further up. And there's an unbalanced growth, and that will continue also to become bigger between where the food is being produced and where it's consumed. And so the famous Asian countries that will be the big consumers going forward, of the 9 billion people living on this planet in 2015, the biggest growth from the 7 where we are will be in those countries, and they will eat, but the production is not going to be there. So you will have increasing tendencies, increasing mismatches between where the food is actually produced and where it's consumed. And all of that will keep those prices up and will keep the volatility up. And we don't expect to see any changes in that for the coming 10 years. Actually, we will see more of that in the coming 10 years. Which could be a good story, but we'll get there. That is not necessarily good. What it does mean, if you make that analysis, is that you have to move. You have to do something. If you're active in the food and agribusiness value chain, and whether it's really on the downside and in the retail, or whether you're upside really producing what we eat, you need to move. You need to do something. This is something that is happening. And this change is a fundamental change. So something has to be done. And we have so we're transforming, as we say it, from a situation of oversupply to one of scarcity and volatility. From managing oversupplies, set aside arrangements, milk quota, the famous mountains of butter and meat and milk powder that we've had in the world, where we had no concerns over availability and of the accessibility of raw materials, we will now go to a situation whereby we have to manage scarcity and volatility. And the access actually to raw materials is going to be the key driver for the food and agribusiness value chain, and to manage the risks of increasing prices and certainly increasing price volatility. So the main trends that we see as an institution happening on a global scale, the main dynamics, are that global food companies with market power will strengthen their influence in the supply chain. And the important thing to remember there is that they are very big and they have power. Smaller and midstream processors and traders will come under the most pressure. Also, this is not new, we've seen it before, but as the fundamentals of the market change, the pressure will change. Global and regional trading houses will strengthen their positions in the supply chain. They will have to get more power. And farmers will be squeezed from all sides. And that also is, of course, nothing new. But it will become worse even, because everybody will be repositioning and trying to squeeze each other. The good news is that food and agribusiness companies increasingly recognize, and will recognize, the need to work with farmers and to support them. F&A companies will need to look also beyond their traditional value chain, look into new sectors, and need to look into chemicals, paper pulp, other types of technologies. But certainly they need to cooperate with the producers actually to get there. So as it is stated at the bottom end of this slide, sourcing as a competitive advantage, which for them is going to be a key driver, it will be a competitive advantage for food and agribusiness companies if they can work with producers. So there's the good. There's the squeeze, but there's also the recognition that basically he or she who owns the produce is the key when it comes to sourcing. Based upon these dynamics and the action that those food and ag players can take, we've developed roughly 3 types of strategies. And I'm sharing this with you because this is mostly focusing on the part downstream. So this is not farmer level, but I still thought it was good for you to know of this part of the research we've done. It is, we've made this research available a week ago at the IMF meeting in Washington, where we also always have a topic that we discuss with the community. And through your regular Rabobank context, which I assure all of you have, of course, you will be able to get hold of the content of this entire study. But it's called Rethinking the Food and Ag Supply Chain, Impact of Agricultural Price Volatility on Sourcing Strategies. And again, it's focused on the whole chain, and a lot of it is actually on production and retailing. But food and agribusiness companies in the value chain need to reorganize. And the 3 types of options that we see, and urgently so, is that there's an increasing control over supply, which you can see as in investing in land, and there will be examples, I'll give you a few examples later on. There's backward integration, farmer first, where buyers actively assisting farmers in the production process. We have regional diversification as a strategy to control supply. So that's on the one hand, where you increase the control. The other one is focus on market power, so becoming stronger, actually to have a power, and to cooperate, to jointly have that power, which is the second one, where you can read on the screen some examples of what that's all about. And then you have adaptive strategies, which we think is the third category to deal with these increasing prices and with the scarcity and with the volatility. Although adaptive strategies, in my view, is a solution typically for the pricing side of it, and not always necessarily for the, if you look at it, the substitution, for instance, or tolling. It doesn't take away the strategic sourcing element itself. It's mostly on the pricing side, as I would say. So those are a few of those examples. If you look at the adoptive strategies, for instance, the substitution, I spoke to you earlier about corn in the US being so much tied into ethanol. The ethanol producers really cannot diversify. They are fixed with the corn. They need to have the corn, and they need to buy the corn wherever it goes. And the government will support the biofuel strategy, so that will just push that market up. As an example there, and I think an example that on the market power, one of the things we talked about internally is the move that Australian Grain Corp made when they branched out into the malt business, because in the malt business they can be much more of a meaningful player to the brewing industry in this case than just in the grains industry, where they're competing with heavyweights as Cargill and Glencore and Bunge. Another way of looking at it is what we call commodity colonization. And I don't mean that in a degrading or a negative way. It is just getting colonies to supply you with what you need. The battle for raw materials. The picture you see here is maybe some of you will know it. It's a game, a board game called Risk. And Risk is a popular game in Europe, for the ones from Europe. It's a strategic board game produced by Parker Brothers. The standard version is played on a board depicting a political map of Earth divided into 42 territories, which are grouped into continents. The primary objective of the game is world domination, or to occupy every territory on the board, and in doing so, eliminate all other players. Hopefully you will not recognize this, and you will never actually really recognize this, because that means total war and scarcity is, in my view, is a very dangerous something. And it's been said that it could be a threat to world peace, and I think it is, if we don't manage it correctly. But we don't believe we're going to go there. We don't believe we will have this risk situation. But the current situation in the agri-commodities market can be characterized as a risk game, a battle for existing pool of raw materials. Driven by risk aversion, tight and volatile commodity markets have been prompting larger players across the value chain and even governments to actively safeguard their own current and future supply base. And that's what we've meant. And if you look at the chart here and you see some of the examples actually of those movements we see, and those movements are actually across the globe to secure precisely that, to secure the sourcing, to make sure that the raw material is available. An example of that is in the Australian sugar. No family. And that one neither. The growing demand for sugar in the Far East mostly is driving sugar markets globally. And you will see, and I'll show you later, that the demand actually is something that is completely out of line with what they produce. So they are looking at Australia as a supplier of sugar. China, for instance, is a big importer of sugar, but they don't import from Australia yet. But everybody's looking at it. And in Australia, the advantage of sugar is also that it is mostly for consumption, and it's mostly for, so it doesn't go into ethanol or biofuel. And on top of that, so much is produced that the Australians themselves cannot consume it. So there's a lot available for export as well. This is the, for the ones that are not familiar with it, this is just a short map of the Australian sugar industry as you see it. And what we've tried to show here is what that international interest in the sugar industry actually has meant. So what we've seen, for instance, we've seen Wilmar buy Sucrogen in November 2010, which you can see in the word section in the north. We've seen we've seen Cofco, Chinese Cofco, bought Tully Sugar Mill in July 2011 in the northern region. We've had Mitterpol from Thailand, have approximately 20% ownership of Marybury Sugar in the northern and southern region. Louis Dreyfus has signaled interest through the backing of McKay's sugar bid for Tully Mill. So they are indirectly involved in that war. Fina Sucre from Belgium, which is a privately owned company, bought Bundaberg Sugar in the southern region. And also companies like Bunge and Bright Foods, again from China, are making serious bids into the sugar industry. So all of a sudden you see this sugar industry becoming very much in the focus of Asia, predominantly Asia, to secure what they foresee as a scarcity of sugar to satisfy the demand. And that scarcity is very clear here. And I think the line to focus on most is the one that is slowly going down. And going down in this sense means getting more negative. And that shows you Asia's sugar deficit, which is 17 million tons per year and growing. And clearly Australia cannot solve that, so they're not buying those sugar interests actually to solve the entire problem, because Australia produces between 4 and 5 million tons. But it certainly helps, and the proximity of Australia to the market makes that the costs for the logistics are low. It's also, I think, good to say that the research is at a high level in the Australian sugar industry, and there is still some land to be furthered into to produce it. Just as an example of what's happening in those markets. If we then go to Australia, and to the current landscape. This chart is trying to show you some of the issues in the current agri-commodity space and in the trade landscape for both buyer and producer that could potentially be resolved by better cooperation along the supply chain. And what you see here is that the options that you have as a grain producer in the country, and you walk down the chair and you make choices of whether you go on your own or whether you immediately in the light is a bit dark now. but you immediately go into supply contracting, or whether you go on your own. If you go on your own, do you take what is there, or do you still join it? Basically, at the end, there's four options, and you can go into the pool. And for the Australians in the room, this is very well known. I'm not quite sure to the outsiders, but so you can go into the pool. You can go immediately on the cash market. You can have your own storage on farm, or you can have your storage off farm. And all those four elements contain different risks and rewards in it. And ultimately, the choice that you have there is what sort of risk can you take? Are you able to take? Are you willing to take? And then what is the reward that comes with it? And those are the options that we see at this point in time in the market. At the same time, we know that producers have challenges, but the buyers also have their challenges. And the traders, if you want to call them that way, are looking for greater access. I told you that they want to source those commodities and they want to improve their margins, as always. Farmers are also looking for better farm gate prices. There's soft incentives at this point in time for farmers to go the extra mile, to take the extra bit of land into production, to apply the extra, more risky technologies. Yet it has to happen if those buyers want to procure the amount of produce that they would like to have. So they will have to work together in order to overcome that problem that they jointly have. And here you see the one to the left is the farmer, obviously. So, the solution, or going to the solution, would be to enhance the cooperation between producers and buyers, and that is needed in a time of scarcity. If we accept the concept of scarcity, of lasting scarcity, of increasing prices, of higher volatility, we need to have a better cooperation between producers and buyers. And on this chart, what we've tried to show you is some of the issues on the top end that producers face in the various stages of the production cycle, and to the bottom, on the bottom part of the slide, you will see the solutions to it. And a lot of these, and I won't mention them all to you also in the sake of time, but a lot of these issues have to do with money, with capital, and they have to do with scale. And hence, I would say the solution of creative financing is certainly there, but the creative financing is, as we show in this slide, is also something that could and will be applied and supplied by the buyers. And I'll show you just a few examples of how that actually is working and where that creative financing is provided not by a traditional bank. Those issues, the issues mentioned here, most of you will recognize that they're not new. They've been around as long as the business has been there, but they become more urgent. A solution is needed. This is one of the examples, which is the co-production model. As you'll see there, both an investor and a farmer will provide what they're good at and what they're best at. Here in Australia, there's an example of a company called AACL. It's actually listed even on the exchange. And basically what this model does, it takes away the biggest risk, but also the biggest return for the farmer. So it dampens actually the volatility in earnings that the farmer can have, but also the risk is lesser. So that risk and reward always go hand in hand, we all know that. But this model actually has been working, but it's working in a small scale, and as far as I've been confirmed, it's the only one that we see. But certainly the essence of it, the essence of cooperation between an investor and a farmer in the way, as we say it here, is good. The thing what happened here with AACL is that a credit squeeze somewhere in mid-2010 actually led to Glencore. You'll know Glencore as one of the largest trading companies in the world, actually become the major source of funding for that company. And that actually means that Glencore steps in as the creative financer, if you like, but also supporting this development and this way of financing. Another example is what we call the warehouse cash flow. This is, and it says a solution ahead of its time. That is because this is a product that we as Rabobank have had in the Australian market for a couple of years, which has received a very low pickup. And we believe that it is a very, not because it's ours of course, but we believe it's a very good product. And actually it allows farmers to sell part of their produce into what we call this cash flow. They sell it and they receive, say, 60%, or 60% is a bit the norm, so you overcome the cash flow hurdle, or he gets cash for his grain, but he can buy it back, or he can sell it on. Basically, you sell it on to an approved buyer of the cash pool, and then the differential you receive, but should you want to do something else with it, you buy it back and you sell it elsewhere. The advantage that it gives you is that you stay away from what traditionally is always seen as the low of the market, which is during harvest, so you can actually put it away and still receive some cash, which you typically at that point in time need with the farm. So we believe this is an interesting product, but it probably maybe needs some more time, or maybe we need to be pointed out at some of the deficiencies of it. This is also an interesting one, and for some may be creative, for others it's not. This is bartering inputs for grain is something that, and I've had the privilege of working quite a bit in South America. In South America this is very common practice still, it has always been. Traditionally it had to do with the size of small farmers actually, and of the absence of banks in the agricultural space. So basically what you get then is that input suppliers, and whether it's fertilizer or seed or both or whatever, will provide that and have extended payment terms which are then settled against the product in the end. In the old days that finance was provided and the produce being rendered over to the supplier of that credit would only ask for that product as a collateral, as a security for the financial risk he or she was taking. And nowadays that will change, because nowadays those suppliers will actually, they want to get hold of the produce. They want to get hold, the sourcing is the key, so they want to get hold of the product. And therefore you see trading companies like, for instance, Louis Dreyfus in Brazil making investments into a fertilizer company, actually to be with that fertilizer, getting hold, getting a relationship with producers, making sure that they can capture the flow of products that will come out of the country there. Barter trade might be a bit more problematic in Australia due to more of the challenging climate here and a bigger production risk. But it's certainly something to look at. And another type of bartering, which will work anywhere, is Chinese bartering. And the Chinese, they do not just give fertilizer and one product, they will provide a country or a region with a complete infrastructure. And we've seen that happening in Africa, of course. The infrastructure sometimes goes as far as also into political infrastructure, which was probably not intended by the host country. But this is another way for China actually. We've seen a lot of Chinese movement actually outright buying into properties, into land, into production around the world. There was some resistance to it, so now they've gone into this barter, whereby they supply something and then get something back long term. And the Chinese are very brave, and they're not afraid of dealing with countries that the rest of the world believes are a bit more questionable, like Venezuela or Ghana. So that gives the Chinese really a very good insight into an opportunity into that battle for sourcing. So the conclusions for today: the global food system has been brought to a tipping point, and the battle for ag commodities will only intensify. When and how the food and ag supply chain responds are still open questions. Whether to respond is not a question. A possible double-dip recession, or a rolling back of the policies on biofuels, for instance, may impact the timing of what we're heading for, but it will not change what is happening today. The prices will go up, and the volatility will go up too. It's a new phenomenon, and it is really different from what we've seen. The larger players in the food and agribusiness and the governments are looking into minimizing their risks by securing the current and future agri-commodity supplies, while at the same time dealing with higher price risk levels. In doing so, they may well raise the stakes for companies that have remained on the sideline. So it is not a question to respond, we have to respond. The battle for agri-commodity supply in the next decade is only the beginning of a profound transition. In the next 40 to 50 years, the F&A sector will need to double agri-commodity supply with access to only about half of the current land, water and mineral resources. So delivering this four-fold improvement in output is the overwhelming challenge facing the incoming generation of F&A leaders and farmers. So this is the end. This is very important. The small print is a disclaimer. You can read it at pleasure at home.
Thank you very much. Thank you very much indeed, Thos. That was excellent, and also indicating that any ways to unravel the creating banking or creative financing, I think, is very much tied to supply chain issues, which I'm sure that will come out in our discussion. I'm going to take two questions before then we assemble all the speakers onto a panel. So can we have first question to Thos, please? Roger Versa over here. Perhaps if you shout, Roger. Yeah, got a mic.
Yeah, right. There seems to have been a big increase in the level of commodity trading on the financial markets that may have taken the level of volatility greater or lower than maybe should be. Do you feel that's good or bad for agriculture?
You might have to come to the mic here. Yes.
There's probably not the right or wrong there. I think the fact that there are entities on those markets that buy and sell for a financial purpose only makes that there is volatility on those markets. However, if they on themselves make those markets move, they lead to more volatility because of their financial objective, which is typically more short-term oriented. So they will, if something goes up, they will make it go up further, and if it goes down, they will make it go down further. So I think in general the answer would be that yes, it's good that sort of liquidity is available, but it is, but I'm not so happy with the fact that it disturbs really what the character of those markets should be, which is actually to mitigate the risks that you run as a physical buyer or seller of goods.
So, another question. Oh yeah, Mark, moderate.
Yes. Yes, just carrying on that last question. Being a banker, you've been very up with the economics situation in the world. If Greece defaults the next payment of the year and we have some sort of economic turmoil, what impact does that particularly have on commodity prices? Like with the GFC, we saw the soft investment in the soft commodities take off, including wheat. Will that likely to happen again, or will that tend to put a dampener on prices?
Well, we have debated that as well. As you can imagine, we nowadays dream of Greece. We used to do that in the old days as well, prior to holidays. Now we do it even during our holidays. And the impact of Greece on commodity prices will be moderate. And what we see is the tendency of those increasing prices and the volatility. It will add to the volatility for sure, because all the markets will become more volatile if that happens. There will be a roll-on effect to other parts of the European economy and global economy, and those impacts are bigger than specifically on the commodity market. One of the things we've questioned also is if you look at that increasing trend in demand, so in consumption, that is happening mostly in developing countries, in countries that are on their way to further income distribution along their population, creating more middle class. And that's where the dietary changes take place and where the demand for more food will come from. It is not from Europe, which is in decay, let's put it that way.
Right, Thank you very much indeed, Thos, and Thos is going to join us now on the panel anyway, of the plenary speakers. So thanks very much indeed for a very thought-provoking presentation.